Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 24th of March. I'm Daniel Lam, your host for the podcast. One of the FAQ from clients is why China onshore equities, i.e. the A-shares, have been underperforming the China offshore equities. Well, that had to do with the composition. The year-to-date rally in Chinese equities has largely been led by optimism around the launch of DeepSeek's reasoning model, which has triggered gains across information technology, communication services, and consumer discretionary sectors, areas that we are overweight. The outperformance of China offshore versus onshore equities can be largely explained by the difference in sector weightings. So the three sectors comprise approximately 63% from offshore equities, but only about 26% on onshore equities. A few catalysts continue to justify the valuation premium of offshore versus onshore equities going forward. Firstly, continued developments in AI and the rising adoption of lower-cost large language models will likely help the earnings outlook. Earnings expectations for the three sectors in 2025 are 58% for technology, 16% for consumer discretionary, and 11% for communication services. Those tower over that of the broader MSCI China Index, which is at 7%. Secondly, economic concerns are likely to weigh on cyclical sectors, with a likely disproportional impact on onshore equities, given the sector composition. Now, in order for this to turn, we need to see consumption data in China to pick up and a reversal of the disinflationary trend. Is DeepSeek going to eventually loop back to the mass economy and help generate wealth effect? Well, we believe this is going to take some time. This is because 50% of jobs in China is in agriculture, manufacturing, and construction, versus only 20% in the US. So therefore, it is relatively more difficult to make such labor-intensive areas more efficient by AI. Hence, we believe investors in Chinese equities should look to buy the dips on the Hang Seng Technology Index, which is still trading cheap versus its 5-year average, but may experience short-term pullback due to the aggressive run-up that we've seen over the last 2 months. A yardstick would be a correction in the Hang Seng Index to the support level at 22,600. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.